So I finally got back from my 2-week vacation in Tasmania. Beautiful place. The only thing is that the internet was shit. So I'm really glad to be back in Singapore where internet's strong again and I can start looking at the markets, start trading the markets, and of course do this update for you guys. So let's take a look at where we are in the markets. Now I'm looking at the S&P 500 and of course we started this correction early this year. And we went down and we had the first bullish reversal pattern over there, but it did not last that long, right? It went all the way up and it found resistance at this level. And by the way, this level is actually the 61.8% Fibonacci level. If you use your Fibo tool, you can see this is the A to B wave. We call that A, B, C. So it hit this resistance at 61.8% Fib level, right? And then it came back down again. And then we had a second bullish reversal pattern, which I mentioned about a week ago when I first started my vacation, that we had this bullish reversal pattern, went up, and then again found resistance right here. And by the way, this again is another Fibonacci 61.8% level. If you take a look again, this is A, B, C. Check it out. A, B, C. And again, voila, this is the 61.8% Fibonacci level. So this Fib level seems like a very strong level, right? So it hits the level, comes down, hits the level, comes down. And again, it's been coming down over here. So what I did was actually on vacation, I was like kind of like shorting the market using options, using bear put spread options and making a bit of profits as it went down. Now, but it has not gone below this previous swing low, which means in a way, this current reversal has not yet been invalidated. Right now, it is still in play. So the question is, are we towards the end? Are we near the bottom of this correction where we could rally back up? Or could this turn into a much bigger bear market where the market could go down even lower in the next couple of months? Now, at the beginning of the year and last month, I said that the chance of a recession, the chance of a bear market this year was very low, was only like 10%. But you know what, guys? In the last couple of weeks, things have changed. Things have evolved. And I mean, one of the things is, of course, now the protracted war, the Russian invasion of Ukraine causing commodity prices, oil and gas prices to go really high and, of course, pushing up inflation even more. But there are two things I'm looking at that have really evolved, and the chances of a recession, the chances of a bear market have gone up significantly. So I'm going to talk about what I'm looking at right now. Now, before you freak out, remember something. You know, in life, there's no such thing as something that's good or bad, right? So a bear market, a recession, it's not good or bad, but it's how you choose to respond to it and what you choose to do about it that makes it good or makes it bad, right? So what I'm going to do is I'm going to tell you that yes, I mean, it's not a guarantee we're going to have a bear market or recession. I'm just saying that the risk and the chances have increased significantly. But there are still some things we need to look at before we know that it's a bear market, before we know it's a recession. But more importantly, I also talk about, as an investor, how do we take advantage of this? And as a trader, how do you also take advantage of this, right? Again, everything in life can be great if you know how to respond to it with the right financial skills and the right kind of mindset. So what has gotten me to change my outlook, to change my perspective? Well, again, like I said, a lot of things have evolved in the markets. And as an investor and as a trader, it's very important for you to have a very open mind, to be very flexible, that the moment things change in the markets, you have to react very quickly and to have a plan B in place. So there are two things that have changed the situation. And the first thing is that the Nasdaq 100 index has just gone into a bear market. So let's take a look at the Nasdaq 100 charts. So first you got to understand, how do we define a bear market? Bear market is when the index price closes 20% below the high, the peak of the market. And you can see that the peak was over here, 16764, and this level over here is 20% from the peak, which is 13415. And what happened was that 4 days ago, when I was vacationing, right, the Nasdaq closed below the 20% level. So officially, the Nasdaq is in a bear market. But the S&P 500 is not yet in a bear market because the S&P is still far from that 20% level. So the S&P is still in a correction, but not yet in a bear market. So the question I asked myself was that, hey, when a Nasdaq goes into a bear market, does the S&P follow as well? So I looked back at history and I wanted to see whenever the Nasdaq went into a bear market, how often did the S&P follow the Nasdaq? And this is what I found. Now, the Nasdaq started in 1985. So since then, it has had 1, 2, 3, 4, 5, 6, 7, and now 8 bear markets in its history. So if you take a look at the first bear market, that was in 1987. It started in 87, ended in 28 October 87. So that was pretty fast. That was like 22 days. And it dropped a total of 41%. So drawdown means from the top to the bottom, what's the decline and the days it took to reach the bottom, right? The next bear market was in 1990. The drawdown was 34%. It took 88 days. Next one was 1998. 28% drawdown took 76 days, and so on and so forth. So you can see these were all the drawdowns. Now, of course, the biggest crash was the dot-com bubble bursting. That was in the year 2000, and the Nasdaq dropped 83%. So that was a total collapse. And it took 900 days for it to reach the bottom, right? Now, so for this particular bear market that just started in the Nasdaq, it started on 22nd November last year. It hasn't bottomed yet, right? Still ongoing. So far, it's down 22% so far. And so far, it's been 75 days. Now, if you take an average of all the 8 bear markets, you can see that the average drawdown was 42%. And on average, it took 231 days to reach the bottom of that bear market. Now, but what I did was I also took an average excluding the year 2000, which was a dot-com burst. Why? Because I don't see this as being close to the dot-com bubble bursting for a few reasons. Number one, during that time, a lot of the companies in the Nasdaq were very unprofitable. But now, most of the companies in the Nasdaq are very, very profitable. So it's a different scenario. That's number one. Number two, during that time, the earnings yield was below the treasury yield, which means stocks were way overpriced. Whereas now, the earnings yield is above the treasury yield, which means now stocks are cheap relative to bonds. So I don't see this bear market being close to the 2000 bear market. So if you exclude that bear market in 2000, then the average drawdown on the Nasdaq is 35%, and the average days to the bottom is 150 days. So what does that mean? So that basically means that we could still have a bit more downside on the Nasdaq, because right now the Nasdaq is down 22%, the average is 35% drawdown. So we could drop another 13% on the Nasdaq. We never know, right? But it's a possibility. But of course, then again, this bear market could also be as short as 98, where it dropped 28%. By the way, 1998 was a pretty similar time compared to now, because that was Iraq's invasion of Kuwait and oil prices went crazy as well. So if you think that this bear market is similar to that bear market, then hey, there was a 28% drop. We're now down 22. So again, maybe we could have done a 6% downside on that. Or maybe it could be like 2018, the trade war, and that was down like 23%. Again, we don't know the absolute bottom, but the point is that we could go a bit lower on the Nasdaq. Now, currently the Nasdaq has been in this bear market correction for 75 days. And the average is 115 days. So in other words, we could possibly have another 40 more days to go, 40 more trading days, which is another 2 more months. All right. So that's on the Nasdaq. Now, like I said, the Nasdaq is right now in a bear market, but the S&P is nowhere near the bear market yet. The S&P is only down like 14% so far. So will the S&P also go into a bear market? Well, if you look at history, well, it's quite possible it may, because so far you can see that out of the 8 times, 1, 2, 3, 4, 5, 6, 7, sorry. If you look at the last 7 times the Nasdaq went into a bear market, the S&P followed as well, all 7 times except once. Okay, so you can see that after the Nasdaq went into a bear market, the S&P went into a bear market as well. Again, and again. So there was never a time when the Nasdaq went into a bear market and the S&P did not. The S&P always followed it. The only exception was in 1998, where it was not defined as a bear market because the S&P didn't close below 20%, but it made an intraday low of 22%, right? Which is, well, a technical thing, right? But if you look at it, basically the S&P does go down as well. So when the S&P goes into a bear market, what's the average drawdown? The average drawdown over the last 8 bear markets for the S&P is 34%. And the average time it takes to bottom is 255 days. Now, some of you may be freaking out and thinking, oh my God, the Nasdaq's in a bear market, so the S&P is going to go into a bear market, and it's now only down 14%, it's going to drop to 34%, we've got 20% more to go, it's going to take 255 days, we're all going to die, I'm going to sell everything tomorrow. No, relax. Hold on to your horses. Not yet. The good news for now is that the Nasdaq may have officially closed into a bear market 3 days ago or 4 days ago, but it kind of like bounced back above that 20% line. So it could kind of be touch and go, right? So I'm watching this level very carefully. This level is going to be crucial. So what I'm saying is this, right? If we can stay above this line, we may not be going lower. But if we close back below this line and we kind of like stay there for a few days, then there's a high chance this Nasdaq bear market is confirmed and high chance the S&P could follow suit. And then of course we'll have to go to plan B. Now don't worry, plan B doesn't mean sell everything, because again, there are strategies to benefit from a bear market. It's not the end of the world, right? If you take advantage of it, you can really make a lot of money from a bear market. So anyway, so that's the first reason why I'm getting more bearish, because of this. But again, I'm waiting to see if the Nasdaq can hold that line, right? Or is it gonna close back below that line? So far it bounced off that line. Let's see if it can stay there for the next few days. The second thing that got me a bit more bearish is the fact that the S&P 500 had a medium-term downtrend signal. All right, so take a look at this. When the 50 moving average, which is this blue line, when it crosses below the 150 moving average, the green line, and they start sloping down, that is what we call a medium-term downtrend signal. And this just happened a few days ago. Darn it, when I was vacationing, right? I'm going to stop going on vacations, because when I go on vacations, this shit happens, right? So anyway, so you can see this crossover that happened, so which means that the S&P is now on a medium-term downtrend. So whenever you have that crossover, what happens? Let's take a look at history. So you can see from this table that in the last 33 years, the 50 moving average crossed below the 150 moving average 11 times. So it happened 11 times in the last 33 years. So on average, it happens once every 3 years, and it just happened now. So when it happened, did it turn into a bear market? Not all of them turned into a bear market. So you can see that out of the 11 times, 6 of them led to bear markets. These are the ones in 87, 1990, 2000, 2007, 2018, and 2020. And 5 of them did not turn into a bear market. They stayed as corrections. Again, what's the difference, right? So correction means that the drop is between 10 to 20%. That's a correction. More than 20% is a bear market. So if you take a look at all the 11 events when this happened, if you take the average of all the drawdowns, you get 30% average drawdown. And the time it takes to bottom is 137 days. Now, if you average the corrections, which are the ones between 10 and 20%, that's an average correction of 17%, takes 80 days to bottom. And if you take an average of all the bear markets, that's a 36% drawdown on average with a 185-day to bottom average. So again, what does this mean? This means that if the S&P stays in just a correction mode, then we will have very limited downside of about 17%, which is what I said anyway at the beginning of the year. Now we are down 14% so far, so another 3% at the very most on the S&P. But if the Nasdaq closes back below that 20% level and the Nasdaq really confirms that bear market and the S&P follows, then again, we could see a drawdown of up to 35-36%. And like I said, there's no guarantees. We can't predict the future for certain because there are too many moving parts. There are too many variables because we don't know what Putin's going to do next. We don't know what oil's going to do next, right? So the important thing is that as investors and as traders, we have to watch all these different variables and we have to react accordingly and to stick to our investment and trading plan. And the important thing is not to freak out, is to remain calm and to relax and to stay rational and to make rational decisions. So if the S&P and the whole market indeed goes into a bear market, what should you do as an investor? What's the right thing to do? Should we sell all our stock, get out, and buy back in when the bear market is over? You know something? I used to do that many years ago. I used to kind of like, oh, it's a downtrend, let's get out and let's jump back in again. I used to do that in the past, but I don't do that anymore. And I'll tell you why. Because over the years, I've learned that many times when you kind of like sell in a bear market or crash and you hope to buy it back, usually you don't get to buy it back. And usually, even if you buy it back, you tend to get back in at a much higher price. So I've learned over the years that it's better to just stay put. As long as you hold on to high quality companies that are profitable and are making money, you have no worries. Because these good companies, they will always bounce back higher than ever before. So I would just hold my companies. But what is also important is to ensure that you're not one of those people who's highly leveraged, which means you have borrowed a lot of money, you're investing on margin, right? That's why I keep telling my students, don't buy on margin, because if you buy on margin and the market drops 20, 30, 40%, you get a margin call and you don't have the money to top up your account, the broker will force you to sell at the worst price and you're forced to sell all your stock at the worst price, and when the market goes back up, you're not there to enjoy the rebound, all right? So the point is this: if you're someone who's not investing on margin, which you should not be, if you're holding great quality companies like me, nothing wrong just staying put. Just hold it, right? Because even if it goes down for a while, it's going to bounce back a lot higher eventually. And what you should do is, as it goes down to certain levels, support levels, take the chance to nibble and add more shares of high quality companies to average down your cost so that when it rebounds, you'll be extremely profitable. For those of you who know how to use options, you can also use options to kind of like make some money during the downtrend, the short-term downtrend, by using bear put option spreads. So these are the many things that we use in our options course and in our community. But a word of caution, remember, in a bear market, for example, a correction, prices don't drop in a straight line. Nothing goes in a straight line, as you guys know. They move in waves, right? So in a downtrend, it's wave down, wave up, wave down, wave up. So it's always in a wave pattern. So if you want to short the market using options, for example, the mistake people make is they wait for a drop and they short the market and it goes up and they lose money, all right? So remember, if you want to short the market using options, always short after a rally, which means after a wave up. Wait for a wave up to a resistance level, then you short, it goes down, you take profit. So for example, over here, you can see it goes a rally, hits a resistance, you short it, goes down, take profit. Rally, hits a resistance, short it, go down, take profit. So you can do that, but you need the skills of, again, technical analysis, understanding resistance and wave patterns, and of course, using the right options strategies. Now, if you don't use options, you want to short using ETFs or you want to short the stock, be careful, right? Because if it gaps up, you could have unlimited loss. And that's why I like to use options, because with options, there's a limit to how much you can lose if the market goes up, because you only lose the premium that you pay for the option spread. But if you short using futures or stocks and it gaps up, you don't have a stop loss, it could lead to unlimited losses. So unless you're really experienced, unless you really know how to use options, don't short it, right? Unless you really are good at this stuff. But if you're good, go ahead. But again, not necessary. You're holding great companies, hold on to it and keep adding to those good companies as they go down to support levels and stocks are undervalued. It will rebound. And even if it goes into a bear market, seriously, I don't expect kind of like 2000, like 85% drop, or the great financial crisis, 50% drop. I don't see that happening because the conditions are very different. So to me, even if we go into a bear market, I'm looking at something close to 1990, right? And this is what the chart looked like then. So this was what happened back in 1990, and this was when Iraq invaded Kuwait. So very, very similar conditions. There was a war, oil prices went crazy, and we had this bear market. But the bear market was pretty short and sharp, right? It went down, the 50 crossed below the 150. It was just a 20% drawdown, and it rebounded pretty fast, right? And it took like 65 days to reach the bottom. And right now, we are already at day 40, right? So, you know, it could wrap up in the next 20 days as well. So this is something that I see. So again, as an investor, take advantage of it and don't freak out if you hold good quality names. Now, but if you are someone who's currently highly leveraged, which means you have borrowed a lot of money on margin, then I would say, if I were you, I would reduce my leverage, which means whenever I see a market rally, remember, even in a bear market, it won't go down straight. You will have strong rallies, relief rally goes down, rally goes down. So when a market kind of like goes up, I think tonight it looks like it's going to go up, I would want to sell some positions if I'm highly leveraged to reduce my leverage. Because you got to think, if this sucker goes down another 20%, you must be able to hold it. Right? If you have holding power, you have no worries. If you're holding good companies, you have no worries. But if you're holding crap companies with high margin, then you got to worry. Then you want to reduce your leverage. You want to get out of those unprofitable stocks when you get a chance during a short-term bounce. All right? And finally, for those of you who are trading, very, very simple. In trading, you know, on a downtrend like now, you don't want to really go long, right? You want to go short. You want to take short trades using options, whatever it is, and keep your risk small. Always risk 1% or 2% of your portfolio on any trade, and always risk $1 to make $2 or $3 for your short-term swing trading. So for trading, it's really simple. You don't want to go long right now. You want to kind of like go short unless we see, again, a very oversold condition. We see a strong bounce, then you could go long. But right now, I would either go short or I would kind of like not take a position until I see a clearer trend in the markets. All right, so in the next couple of videos, I may share a bit more about how to short the market using options if there's a lot of demand for these videos. Again, you can learn it from our community, from our courses, but I can share again some introductory videos to help you guys get started. So hope it's been useful. And may the markets be with you. Let's watch the markets carefully and again, follow your investment and trading plans and think rationally. I'll see you guys soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.